Hey everyone, Sam here. Um, I'm going to do a quick video by myself, just follow up from Seth and I's discussion yesterday around systematic um, trading and the setup and the process and getting started being systematic without being automated and really using your rules overlaid with a chart to quickly see if you need to take any action in a market and what that action should be. So, what I have here is a 200-day Donchian channel on the SPY ETF. The blue line is the upper bound, the red line is the lower bound, and you can see we've been pressing on new 100 and 200-day highs for quite some time. Secondly, if we had a rule that our exit criteria was going to be to get out on 100-day lows in the case of long positions and highs in the case of short positions, then we can add this in here, and this is shown with the thinner line for the 100 period, and the thicker line represents the 200 period. So just in looking at this, you would have gotten long in on April 29th of this year, and you'd still be long based on the simple entry criteria and your exit criteria not being hit yet. We haven't reached a new 100-day low in quite some time. So just based on the simple entry and exit, we'd have a long position and we'd still be in that long position. But we don't know where to place a stop based on this, since we only have sort of one or two different places that it could be based on what we're seeing on our chart, and that's just the 100 and coincidentally the 200-day low way down here, which is at the 2018 low of the market, I believe, or where it bottomed at the end of 2018 and then made its rally basically right at the new year. So we don't have a spot to place an initial stop loss, and because we don't have a spot for an initial stop loss, we can't size our position or know how many shares of this ETF we should purchase. But let's say that the secondary part of our rule is we want to use volatility to size our positions, and we want to use the ATR. Down here I have the 20-period ATR, and you can see as of the end of close today, the 20-period 1x multiplier ATR, so just one ATR over 20 days averaged is $2.20 of this ETF's price. If we've determined that we want our initial stop to be 4 ATRs away, so 4x times this 220 at this point, if we were getting in now, that's what it would be. If we've determined we want it to be 4x, and common multipliers are anywhere from 1 to 10, and I would say I look at things between 3 and 8 typically myself. But if we decided that we were looking at 4, then putting in this volatility stop indicator right here would give us a visual representation of where this stop needed to be at this point. So 4 times the 220 would be 880. The close today was 315.42. So we would expect this volatility stop to be 880 less the close of 315.42. So 306.62 would be 880 from the close, and it's at 306.64. As you can see up in the top there, 306.64. That's likely due to just the rounding errors, things like that. So you could use either. But this gives us a visual representation of where we'd be getting in and where to place our initial stop, which would also allow us to size the position, and then where our trailing stop or exit signal would be if we got to that point and it overtook the initial stop. So let's just, for the sake of going through time here a little bit, go through what this would look like. So back in April 29th, the Donchian channel hits a new high. We get a new high above this period. This is our entry signal to enter the market long at the end of this trading day. So we would get long. Our initial stop would be right here at this 4 ATR, 20 period 4 ATR location, and we would have been stopped out a week and a half later or so. Then we'd be out of the market all this time. Then we get a new high in June, and our stop would be right here at this 283 69 level. Or 3.04 times 4. Take the 1216 from the close, and you get 283.70. So 283.70, 283.69 based on the indicator, whatever you feel comfortable with. You can also just understand the script or the language that your software, your charting software has. Learn that a little bit, and then you can quickly go to the ATR, make a custom indicator, and just multiply it by 4. So when you came down here, you would see 4 ATRs rather than just 1, and you'd have that number below as well. But you'd get long here. It would go up a bit. The 100 period hasn't kicked in, so your initial stop is here, and it stays here until you get stopped out again here in August. Then you stay flat, and you get a new high. Here, you're just looking for the Donchian channel to hit a new high based on price hitting a new high. You get long here. This would be your initial stop in this area. You get stopped out again, so that would be 3 losses on this at this point. I'm not going to go into the concept of, is this a good strategy or not, or should you be using it on an index rather than single markets. That's a topic for another time, but this is just going through the mechanics of being systematic. So you'd get stopped out there. You don't have anything to do any of these days. You look at your chart. There's nothing to do. You move on to the next one a couple seconds later. Then you get another long in here. Your stop is right here, and your stop hasn't been hit yet. You'd be long at this moment back in October, and you'd still be long now. Your stop would still be at your initial stop location because the 100 period low hasn't gotten above your initial stop. So you're just taking the closest of the two to the market or the position itself, and you won't adjust that stop at all until this 100 period gets above it. So this would be, you're in a long market. There's nothing to do at this point. You're going to have a stop loss in the market right here, your initial stop. And if it gets hit in the middle of the day, then it does. If not, then you're not going to do anything with this until it gets to that point and or gets down and hits a new 200-day low. So let's say you were trading ag, the aggregate bond position, that would be the same. So you can see back here, you would have gotten long. You would have been long this entire time. And you would still be long at this point based on a 200-day breakout. Start of 19, be at this 200-day high up in here. The initial stop is down in here, which hasn't been hit, and it's just been going up. So the 100 period low is still here. This is where your stop would be at this point. If this were to go up a little bit, you would just move your stop at the end of the day to that new location and move on to the next market. Let's see if there are any currencies that happen to make any positions. So at this point, you would have entered short down in here. You would have gotten stopped out back here, and you wouldn't be This market would be flat right now. No new signal today because there's been no new 200-day high. So I would just go to the next market. This one is, I would have been long here. My initial stop would have been down in here, and I would have just gotten stopped out a couple days ago. So this position would be flat and nothing, no new 200 period high or low on this one today. So nothing to do on this market today. This one we had a new low here, and the stop is up in here, and it looks like you're probably still short. I don't think it hit the initial stop, so it's still in a short position at this point for the Australian against the dollar. This one you would have gotten long back here, then it would have gotten stopped out. You would have not hit a new 200-day high or low, so this market would still be flat this entire time. You would have been flat all the way since February of this year. You haven't gotten a new signal. It's just been going sideways and hasn't caught up yet, so you're waiting for it to breach this bound up here or this one. It didn't do that today, so there's nothing to do in this market. Similar to this one, you would have been short back here, and you'd still be short now, although your stop would be right here at this point. So you're getting close to the stop, but it didn't get hit today. You didn't get a long signal either, so this would still be a short position. No trade on this one, no 200-day high. This one you got short back here, and you would still be short, and your stop would be right here in the market. Similar to this one, you're still in a short position. Nothing new happened today. And this would be the process that I would go through myself every single day for each of the markets that I trade. This would have been a long position here. Your stop would have been right here. You would have gotten stopped out. Remove these. This is getting close to hitting a new 200-day low for the euro pound. Not quite, but for the sake of demonstration real quick, I will show how quick it would be for me to at least get the position that I'd want to put on and size it appropriately. So at the end of the day today, the 20-period ATR is 0.0052, which would be 52 pips in the Forex market. You can think of it as ticks. So the 4-period ATR is going to be around 208. And you can also just click this measuring tool over here on the left and get an idea of the 208 pips from this close. Is up here, 207.4, 208. It's about where our volatility stop is. Remember, we've looked at that. There might be some small rounding errors, but the volatility stop 4 ATRs away says our stop should be placed at 0.87200 for this exchange rate, the British pounds per euros. So we'd be, for the sake of this, we'll act like this was a new 200-day high. We would get short, and I just have a demo account here, paper trading through TradingView for this example. To use it, but let's say we were going to put in a sell limit order for the close of this day. 0.85117 would be the exchange rate that we'd want to put it in at. Our stop loss is going to be sort of 4 times the 52, so you could use the 108, and that would get us at 0.86197. which isn't quite right. It should be, let's use the volatility stop instead at 0.872. Sorry, that's, 208.3 pips, which would be about 4 times the 52 that we see at the bottom. So that's the price where our stop is going to be. And let's say we are risking 1%. We have a paper trading account balance here of 29,967. So a risk 100% or 1%. So we would do 299.67. And this would give the size of the order that I need to put in the market, which is 11,127 units. If you're familiar with how currency lot sizes work, a standard lot is 100,000 units of a currency. So this is roughly 11% of a standard lot. I don't know if this is going to execute. Yeah, it did. So just to give a sense, that would be our sell limit order. This is where our stop loss is in the market. We have no take profits for obvious reasons. We don't put take profits in the market. And then you could go in and you can update it as need be. So if the 100 period came down, then you could just update the stop loss position to be closer to the market if that's what your rule dictated. And obviously, if it gets executed and it hits my stop loss back up here at 0.872, then I'm going to lose $299.67, and that's going to be a 1% loss on my account. So that's how I would initially look at sizing from a systematic yet non-automated perspective. You need something to tell you where your stop is going to be and how much the risk should be for that distance from the market to that stop, and that'll determine how many shares or how many units or contracts, whatever it may be, how much of an asset you acquire at that time. You also should be thinking about it in terms of that order as well. The volatility of the asset at that point in time, or the recent volatility over recent periods of time, determines where your stop is going to be. Your initial risk per position is always the same based on your tolerance and or other compositions of your strategy and portfolio, and then you determine the amount of something that you're going to buy or sell. And that should be the flow of steps in your mind. It shouldn't really be in any other order, trying to determine to buy a certain amount of something first, and then figuring out where to place the stop, and then how much to risk. That would be doing it sort of backwards and or inconsistent, and you wouldn't be basing the position based on the rules and or the market action itself. You'd be doing it based on something else. So that's how I go about doing it. I would just cycle through a variety of different markets like this at the end of each day. And even just if you have simple rules like this, it's easy to see, has price hit any of the levels that I have in my strategy here? And if not, then I can just go on to the next visual. Obviously, when you have it set up like this and it's in a visual chart format, it's easy to see if you need to take any action, especially with only just a couple of indicators. If you're using multiple things to determine your entries and exit, and it clutters up a chart, that will also be where understanding the scripting or language of the software that you use will come in handy, so you can create a custom indicator that brings all the components that you look at to determine a signal, whether it be entry, exit, the initial stop, trailing stop, all of those things. If you bring those together and provide a way to see that as an aggregated one piece to let you know if you have to take any action and what it should be, then it will help you sort of see that more easily day to day when just scrolling through something visual. If you're just looking at sort of numbers and the price feed, then you'll have to get creative with the price sheet that you have and the alerting that you have. Even in Excel, you can set something up to give you some indicators and alerts if something new has happened based on the data feed. But it's also nice to have a nice charting software available to you to be able to just cycle through these and see for yourself if anything needs to be done in each market. And I would go ahead and do this each day. So here was a new 200-day high recently back in October on the pound Australian dollar, and this would still be in a long position here, and it would have been entered at this level, and the stop would be down here. So this is all systematic. I'm looking at just one entry rule, one exit rule, and an initial stop based on volatility, and using that to determine if I need to take action, and then when I do, what's the action that I'm taking, and if it's putting in an order, then how do I put that order in, and how do I know the size of that order? If it's just moving a stop loss order, then I know exactly where that stop loss should be moved and the new price to move it to from the current price. So when I talk about being systematic but not automated, this is the representation of that, and you're just able to scroll through all the markets that you set up. Within TradingView, you can create these little like playlists or just lists with different markets, so it makes it easy to just hit the space bar and run through them really quickly and see if anything's changed. No 200-day high there, no 200-day high or low there, nothing new there, nothing new there, and then that would be the process. So we'll talk about this more in the future. These last few minutes I rambled on a bit, so sorry about that. The first 15 minutes should be pretty solid and hopefully helpful, but this is how you can get started with systematic trading and specifically systematic trend following by using an entry, an exit, and initial stop based on volatility. Till next time, probably the end of this weekend after Thanksgiving. We'll see you guys again. Have a good holiday. Enjoy the sports, enjoy the food, enjoy the family, whatever it may be. See you later. Till then, adios.